FTX, Celsius, BlockFi. A wave of bankruptcies is hitting the crypto industry, and policymakers are calling for
regulatory framework.
We really need to make sure that that environment has the appropriate regulatory guardrails.
To find out how Washington might regulate the crypto industry moving forward, let's look at a few past SEC investigations that reveal how the agency sees crypto. In 2020, the SEC sued cryptocurrency company Ripple over the company's coin, XRP.
It is by far the biggest piece of litigation that the SEC has against a cryptocurrency.
The agency charged two Ripple executives with engaging in an illegal securities offering by selling XRP. The agency argued that it wasn't a currency. It was a security, making the distinction using the Securities Act of 1933. The law says that if something is an investment contract, or one form of a security, it can be regulated under this act. But the courts didn't clarify what that was until a Supreme Court case in 1946. To call something an investment contract, it has to pass a test, aptly named the Howey test. There's just 3 questions. First, has someone invested money? Then, is there a common enterprise? Is the success of the buyer intertwined with the seller? And third, is the buyer led to expect profits derived from others? If all the answers are yes, it's a security.
The Ripple lawsuit says, the SEC are holding their ground and insisting that this whole new world of crypto is really just a new form of the same old function, which is to issue a kind of an asset in order to raise money to build a business.
But some crypto companies, like Ripple, don't accept this idea. They say their products aren't securities, they're commodities, like gold. They say that digital assets with a real-world purpose don't trade because of the seller. There is no common enterprise, so the tokens aren't securities. Ripple said the SEC was acting outside their legal limits, and they would continue to fight the case. In September, both parties filed motions asking a federal judge to render a verdict. With this case, the SEC took its biggest shot at broadly establishing its jurisdiction over the crypto market. Then, a year later, the SEC took the same law and applied it to a new part of the industry, crypto lending. It started investigating BlockFi, a platform that allowed users to loan crypto to others for trading.
BlockFi was doing something that the SEC had not yet enforced against. And the SEC said that transaction, that offering that BlockFi was doing, was also an investment contract, which is a form of a security.
For the case, the agency's reasoning was this. The way BlockFi's product worked is that it borrowed crypto assets from customers with the promise to repay it with interest. That, the SEC said, counted as investment of money. BlockFi would lend those assets to institutional borrowers and keep some profits for itself. There's common enterprise. And based on BlockFi's statements about paying interest, the company led investors to expect profit. So, BlockFi's crypto lending accounts passed the Howey test, making it, in the SEC's eyes, a security.
The SEC moving into trying to regulate crypto lending products shows you that a lot of this crypto ecosystem resembles traditional finance. And the SEC, therefore, is going to look at that and say, that looks like the kind of thing we regulate.
BlockFi settled for $100 million. The highest fine ever agreed to by a cryptocurrency company. BlockFi CEO Zach Prince said the company cooperated with regulators.
We have a long history of compliance and working with regulators, and this is another example of that.
BlockFi, which filed for bankruptcy in November, did not reply to a request for comment. But the case expanded the SEC's use of the Howey test to regulate crypto, showing the agency was willing to target non-traditional digital assets. Then, later in 2022, the agency took aim at a different part of the industry.
Celebrity endorsements, though, don't mean that an investment product is right for you, or even, frankly, that it's legitimate.
The SEC was prosecuting celebrities for advertising crypto. For example, let's look at the agency's recent action against Kim Kardashian. In September 2021, Kardashian posted a video and swipe-up story on Instagram promoting Ethereum Max tokens and was paid $250,000 for the post. The SEC said that because Ethereum Max was a security with, you guessed it, an investment of money, common enterprise, and a reasonable expectation of profits, The agency argued that Kardashian's post should be regulated under another part of the Securities Act that said she couldn't advertise a security without revealing that Ethereum Max paid her. The SEC fined her over $1 million for the lack of disclosure. Kardashian did not respond to a request for comment.
These cases, because they involve celebrities, they allow the SEC to amplify their message to a much broader audience than the SEC's enforcement actions typically reach.
The cases against Ripple, BlockFi, and Kardashian show the SEC's strategy for applying securities regulations to crypto.
The SEC is going to continue to apply these laws to crypto unless and until Congress decides that crypto should fall under its own sort of customized regulatory regime.
The SEC said in May it would add 20 new investigators to its crypto unit. But if regulations changed, some of the crypto market could fall under the Commodity Futures Trading Commission, the SEC's sister agency.
We are going to continue to see a lot of the same kinds of enforcement actions, but we don't know yet if the strategy is going to change somehow because of what happened with FTX.
But it's likely the agency will continue on the path of enforcement in the future.